For those of us who tend to follow gold, we are already aware of announcements from various writers in the blogosphere that the Russian central bank has announced its intentions to back the ruble with gold. Simply do a Google search for "Russia backs ruble with gold," and you're likely to see something similar to what I am showing here. Unfortunately, it's very difficult these days to find credible news sources. It doesn't matter if your interest is gold, stocks, politics, health, or what have you. Most content producers derive their income from advertising, which means it's crucial for them to attract attention, often referred to as eyeballs. It doesn't matter to them if the content is accurate, and the more spectacular the headline, the better. As long as people click on the content producer's link, the content producer will have achieved his or her purpose. So, what is the value of such stories to readers? As a holder of gold, such stories are certainly attractive because they stoke a person's dreams of large capital gains. However, as gold investors, we are better served recognizing the difference between news and entertainment. Facts lead to good investment decisions. Entertainment leads to poor investment decisions. I want all of you, my subscribers, to make good investment decisions based upon real facts, not speculation. You have probably figured out from what I have just said what my opinion is of the claims that Russia has backed the ruble with gold. I'm not a very subtle person. But let me tell you why this is the case, and why they are not likely to do so in the future, and why I don't think redeemability is critical for the bullish case for gold. I'm going to start with the actual news, and then I will discuss the difference between gold as collateral versus gold redeemability. Gold redeemability is what most people associated with gold backing. There is a very profound difference between redeemability and collateral. Here is the actual announcement from the Russian central bank on March 25th. This is the announcement that led to all of the claims of gold backing. The text of the announcement says, "In order to balance supply and demand in the domestic market of precious metals, the Bank of Russia will buy gold from credit institutions at a fixed price starting from the 28th of March 2022. The price will be 5,000 Russian rubles per 1 gram from the 28th of March 2022 through the 30th of June 2022. The established price level makes it possible to maintain a stable supply of gold and smooth functioning of the gold mining industry in the current year. After the period specified, the purchase price of gold can be adjusted, taking into account the emerging balance of supply and demand in the domestic market." The announcement is quite short and very specific, and it's hard to fathom how so many raised the claim that Russia is backing the ruble with gold. It's almost as if nobody read the actual announcement. Now let's focus on two aspects of this announcement. The first has to do with the intent. The Russian central bank stated that it wanted to ensure a stable supply of gold and a smooth functioning of the gold mining industry. Which gold mining industry is it concerned with? Does it care about Newmont, Barrick, or AngloGold Ashanti? Probably not. It certainly cares about domestic mining companies such as Polyus, with approximately 20,000 employees and nearly 90 metric tons of production per year, and not to mention other domestic mining companies. With the sanctions being imposed on Russia resulting from its invasion of Ukraine, offering to buy domestic gold in exchange for rubles will ensure that their domestic gold mining companies continue operation, which means paying employees, making payments on their debt, and producing gold. But this is quite different from offering to sell central bank gold in exchange for rubles, which brings me to the second aspect of this announcement. The central bank specifically stated its willingness to buy at a price of 5,000 rubles per gram. It did not say that it would be willing to part with 1 gram of gold for any entity wishing to redeem 5,000 rubles. It's a really big difference. It's a difference that the US learned was important in the 1960s, and I'll be discussing this in depth a little bit later. Now, in order to be thorough, I should mention that the Central Bank of Russia issued another press release concerning gold on April the 7th. They stated, "Due to significant changes in the market conditions, the Bank of Russia is adjusting its pricing policy when buying gold from credit institutions. From April 8, 2022, the Bank of Russia will buy gold at a negotiated price." Now, it's not surprising that they had to abandon the fixed price of 5,000 rubles per gram. Such a price would be the equivalent of $65 per gram, or 2022 US dollars per troy ounce, which is a 4.5% premium to the spot price of $1935 per ounce today. A result of the ruble to dollar exchange rate rising from 0.01 at the end of March to 0.013 now. This rise in the exchange rate was more likely due to Gazprom negotiating payment for its natural gas in rubles than it was the result of serious speculation about gold backing of the ruble. Now, so why do I think that it's unlikely that Russia will make its ruble redeemable in gold in the future? It's known that Russia's gold reserves were 2,298.53 metric tons at the end of the third quarter of 2021. This places it in the fifth global ranking behind the US, which has 8,133 tons, Germany, which has 3,359 tons, Italy, which has 2,452 tons, and France, which has 2,437 tons. Now, certainly its large gold holding could enable it to make its ruble redeemable in gold, but what would the consequences be if it were to do so? Let's take a look at US history first for a little bit of background and some clues. One can see in this figure the large increase in US Treasury gold during the 1930s into the mid-1940s. Some of this was due to the effects of the Gold Reserve Act of 1934, but much of it was due to the large US trade surplus of the 1930s and 1940s. At the end of the Second World War, the US held so much gold that an agreement was struck with many nations of the world in Bretton Woods, New Hampshire, that the US Federal Reserve Note would serve as the world's reserve currency, with the gold in the US Treasury providing the backing. Nations were still free to redeem their notes as they saw fit, though doing so ran the risk of appearing to be unfriendly or distrustful of the United States. Now, after the war, and partly due to the monetary flexibility the U.S. now enjoyed, the United States entered into a long period of what was called guns and butter. The guns part referred to the Korean War, the Cold War, and the Vietnam War. The butter part referred to new social programs that were launched. The rest of the world was not particularly amused. In fact, in France, the U.S. was accused of abusing an exorbitant privilege, leading French President Charles de Gaulle to announce in February of 1965 his intention to exchange France's US dollar reserves for gold at the official exchange rate. He even sent the French Navy across the Atlantic to pick up France's gold reserve held in the US. Now, this was emulated by several other countries. One can see the rapid drain of gold out of the US Treasury. It was similar to a bank run on a large scale. President Nixon, fearing that the U.S. Treasury would be drained of all of its gold, closed the gold window. He appeared on national television on Sunday, August 15, 1971, to make his announcement, quote, "I have directed Secretary Connolly to suspend temporarily the convertibility of the dollar into gold or other reserve assets, except in amounts and conditions determined to be in the interest of monetary stability and in the best interests of the United States," end quote. Now, what does this action, which is very technical, mean for you? Let me lay to rest the bugaboo of what is called devaluation. If you want to buy a foreign car or take a trip abroad, market conditions may cause your dollar to buy slightly less. But if you are among the overwhelming majority of Americans who buy American-made products in America, your dollar will be worth just as much tomorrow as it is today. The effect of this action, in other words, will be to stabilize the dollar. And that was the end of this portion of his speech. I wish I could have done that in a very good, Nixon accent, but I don't do very good impersonations. Anyway, as it turns out, this action did not stabilize the purchasing power of the dollar, but it did stabilize the amount of gold held by the Treasury at 276 million ounces. The world was placed onto a new monetary system, one that was very, very soft. It is the same system that we're on today. The important lesson that the U.S. learned was that gold redeemability meant the impossibility of running perpetual trade deficits. Gold, being the ultimate money, under a regime of redeemable currency, tends to flow away from any nation that runs a trade deficit and into any nation that runs a trade surplus. With gold, there is a zero bound. Once there is no gold to be redeemed, there is an impossibility of maintaining both a trade deficit and a redeemable currency. Without gold, a deficit can be maintained for so long as the surplus nations are willing to continue doing business with the deficit country. The U.S. has been running a negative trade balance since the early 1970s without its gold being drained, so obviously it has benefited from the cessation of redeemability. So why wouldn't Russia want to pressure the U.S. to resume gold redeemability by placing the ruble on a redeemable basis? Such a move would definitely cause gold to flow out of U.S. coffers and into Russian coffers, at least to the point where the U.S. could no longer sustain a trade deficit with the rest of the world. Now, what would the impact be when we consider all of Russia's trading partners, assuming, of course, that the sanctions are eventually lifted? Let's take a look. In 2020, Russia imported an equivalent of $220 billion worth of goods from other nations, and it exported in the same year $330 billion worth of goods to other nations. These two figures show the breakdowns. Notice 23% of Russia's $220 billion of imports came from China, so this would be $50.6 billion worth. Only 14.9% of Russia's $330 billion worth of exports went to China, or $44.2 billion worth. So this means that Russia ran a trade deficit of about $6.4 billion with China in 2020. Now similarly, Russia imported $26.2 billion worth of goods from Germany, and it exported $14.2 billion worth of goods to Germany, making its trade deficit with Germany $12 billion. A similar calculation can be performed for Russia's other trading partners. Now, why would Russia's trade deficits with Germany and China be a problem for Russia if it were to make the ruble redeemable in gold? Let's think it through a little bit. How would the deficits be settled? In the short term, Germany and China might be willing to allow Russia's debt to them to accumulate, much the way that Europe allowed the US debt to build up in the 50s and 60s. Eventually, they might be tempted to try to reduce the rate of debt accumulation or even put it into reverse. There are two ways that this could happen. The first way would be to increase the prices of German and Chinese exports to Russia. The second way would be to redeem debt for gold. Neither of these are desirable from the standpoint of Russia. But the second way would be tolerable and sustainable, provided the rate at which gold flowed into Russia's coffers exceeded the rate of redemption by Germany and China. And this brings us to the relationship between Russia and its export partners. Notice, for example, in these tables that Russia runs a large trade surplus with the United Kingdom. Would Russia be able to use this surplus status with the UK to obtain the gold that it needed to settle accounts with Germany and China? Only if it threatened to cut off exports to the UK. The UK has run a negative trade balance of a few percent of its GDP for years, and so even if Russia were to be able to force the UK to settle its trade imbalance with gold, it's not in a situation that would last forever. Eventually, the trade imbalance between Russia and the UK would need to be reduced through a reduction of Russian exports, and this would hurt Russia in the long run. The big problem that Russia faces is not that it needs gold. Russia's biggest imports are automobiles, automotive parts, medicines and medical equipment, computers, and broadcasting equipment. It exports largely energy products, which are crude oil, petroleum gas, coal, and it also exports wheat. It needs to continue supplying the products it is good at producing in order to obtain the products that it cannot produce easily itself. A ruble that is redeemable in gold is a potential threat to the status quo. It would potentially make the items that they import more expensive. The situation would be completely different if Russia was self-sufficient with regards to production of the vast majority of goods that it consumes, but this is not the case. The same logic could be applied to other countries to explain why they don't push for a gold redeemable currency. China, for example, is a big exporter of broadcasting equipment, computers, office machine parts, clothing, and telephones. It imports vast amounts of integrated circuits, crude oil, iron ore, copper, coal, automobiles and parts, and soybeans. So, would China want to risk reducing the supply of items that it imports or making them more expensive for the sake of making trade settlement fair? Fair meaning here the reduction in the trade gap? If their reluctance to allow the yuan to appreciate vis-a-vis the dollar is any indication, then I would suggest that the answer to this is no. If surplus running nations don't have an incentive to back their currencies with gold, then deficit running nations certainly will also not want to do so. So where does this leave gold? It absolutely has a role to play, but that role is not settlement of debt upon demand. That role is as collateral. The US decided about 51 years ago, as a result of its experiences with having a gold-backed currency, to maintain gold as collateral for the currency, but to eliminate redeemability upon demand. In this way, gold functions much like the lien against the house that's backing a mortgage. The bank cannot claim the right to the house without the loan being in default, but the lien against the house still has some insurance-like value to the bank. This posting from the US Treasury demonstrates this to be true for gold. The significance of the highlighted paragraph is that in the event that Congress votes to dissolve the Federal Reserve System, the Federal Reserve notes will be taken over by the US government and will be considered first liens on all of the assets of the Federal Reserve banks. These reference notes are the physical notes that have been printed by the Bureau of Engraving and Printing. The assets of the Federal Reserve banks consist of U.S. securities, namely bills, notes, and bonds, and gold certificates. If the U.S. government assumes the assets of the Federal Reserve, then obviously the U.S. securities on the asset side of the balance sheet will cancel against Treasury liabilities, leaving only the gold certificates. The gold certificates are a direct claim on U.S. Treasury held gold. Therefore, the physical Federal Reserve notes, is how the U.S. Treasury gold is encumbered. Essentially, the system is a very large-scale fractional reserve gold-backed banking system for which the collateral, is gold, is not immediately callable by the creditors as it once was. It's an arrangement that the rest of the world has learned to live with. Now, just as the U.S. maintains a large reserve of gold, each of the major countries have accumulated gold. However, none have made the move to make their currencies redeemable in gold. The reintroduction of gold redeemability is not something that any nation is going to do willingly. Doing so is to threaten the global supply chain, which is not in the interest of any nation currently. Now, does this make gold an undesirable thing to own? Absolutely not. We haven't been on a fully redeemable gold-backed currency system for over 50 years. Yet the nominal value of gold has climbed from $35 to $1,935 per ounce. Gold. Get you some, even if the currency is not redeemable.